Most people who are new to crypto don't realize this, but the biggest mistake they make happens before they even buy their first coin. It's not choosing the wrong project, it's not using the wrong exchange, and it's not even a lack of technical knowledge. The real mistake is timing, and more specifically, why they choose to enter the market. Again and again, most crypto beginners enter at the worst possible time. Not because they are careless, but because they are human. Crypto markets move in cycles, and human emotions move with them. When prices are low and the market feels quiet, interest disappears. No one is talking about crypto. News coverage fades. Social media goes silent. To a beginner, this feels like danger. It feels like something is wrong. But when prices rise sharply, everything changes. Suddenly, crypto is everywhere. Headlines become optimistic. Social media fills with screenshots of profits. Friends who never mentioned crypto before start talking about it. At that moment, the market feels safe, and that feeling is exactly what pulls beginners in. When prices have already gone up for months, the risk feels invisible. The upward movement creates an illusion that the trend will continue forever. Beginners assume that because the price has been rising, it must still be early. But markets don't work that way. By the time the majority feels confident, most of the upside has already happened. Early participants have already positioned themselves. Smart money has already taken risk. What's left is momentum driven by emotion, not value. Beginners don't enter because the opportunity is best. They enter because the fear of missing out becomes unbearable. FOMO is powerful. It convinces people that waiting is dangerous and acting immediately is smart. It creates urgency, and urgency shuts down critical thinking. Decisions are no longer based on understanding or strategy, but on emotion. This is why so many beginners buy after massive price increases. They are not responding to logic, they are responding to excitement. And excitement is one of the most expensive emotions in financial markets. Another reason beginners enter at the worst time is because they confuse attention with opportunity. When everyone is talking about an asset, it feels important. It feels validated. It feels real. But attention usually peaks near market tops, not bottoms. Markets move quietly when value is being built. They move loudly when value is being distributed. Beginners rarely recognize this difference because no one teaches them how market cycles actually work. Instead of learning structure, they learn narratives. They hear stories about people getting rich. They see predictions about prices going higher. They believe that buying now is safer than buying earlier. But the truth is the opposite. The more comfortable an entry feels, the more dangerous it often is. Another major issue is that beginners enter crypto without a plan. They don't know why they are buying. They don't know how long they want to hold. They don't know how much volatility they can emotionally handle. Without a plan, every price movement feels personal. A small dip feels like failure. A larger drop feels like panic. A sudden pump feels like confirmation to buy even more. This emotional roller coaster leads to predictable behavior, buying high and selling low. Not because beginners are irrational, but because they are reacting instead of executing. Media plays a huge role in reinforcing this behavior. Positive news dominates when prices are already high. Negative news appears when prices are already low. Beginners trust headlines because they lack experience. But markets move before the news does. By the time the news sounds good, risk has increased. By the time the news sounds bad, opportunity is often forming. Beginners also tend to underestimate how long markets can move sideways or downward. They expect fast results. When those results don't appear, frustration sets in. That frustration pushes them to enter later, closer to market peaks, when things finally look exciting again. This creates a painful cycle. They wait too long when patience is needed. They rush in when caution is required. What makes this even worse is that quiet markets feel uncomfortable. Low volatility feels boring. Sideways price action feels pointless. Beginners interpret this boredom as a lack of opportunity. But in reality, those quiet periods are where strong positions are built. Experienced participants understand this. They accumulate slowly, they manage risk, they prepare emotionally for volatility. Beginners avoid these phases because they don't provide instant feedback or excitement. Crypto doesn't reward speed, it rewards discipline. The biggest shift beginners need to make is not learning how to predict the market, but learning how to behave within it. Instead of asking whether now is the perfect time to buy, the better question is whether they understand what they are buying, whether they have realistic expectations, whether they are prepared for uncertainty. Tools like dollar cost averaging exist for a reason. They reduce emotional pressure. They remove the need to be perfect. They allow participation without chasing hype. Most beginners fail not because crypto is unfair, but because they enter emotionally unprepared. They follow excitement instead of structure. They chase confirmation instead of understanding. The market doesn't punish beginners for being new. It punishes emotional decisions. If you want to avoid entering the market at the worst time, stop following hype. Stop using excitement as a signal. Focus on learning when things feel quiet, not when they feel obvious. Crypto is not a shortcut. It's a long-term environment that rewards patience, consistency, and emotional control. Those who survive are not the smartest or the fastest. They are the ones who learn before they act and stay calm when others lose control.